Hi, welcome to this episode of the First Trust ROI podcast. I'm Ryan Isakainen, ETF strategist at First Trust. Today I'm joined by Richard Bernstein, CEO and Chief Investment Officer at Richard Bernstein Advisors. Rich has been around Wall Street for over 40 years. Most recently, he was the Chief Investment Strategist at Merrill Lynch before starting RBA over a decade ago. We have a wonderful conversation ahead. Rich and I are going to talk about themes like deglobalization, what that means for the economy, what that means for inflation, and what that means for opportunities in the stock market. Thanks for joining us on this episode of the First Trust ROI podcast. So Rich, thanks again for agreeing to be on the podcast. We were just talking, one of the last times that I remember you and I were together in the same place was in 2020, and I looked it up on my calendar, January of 2020, right before the world shut down, and we were both at a conference in Beverly Hills. Had dinner at a nice Greek restaurant, which again, it was more impactful for me. You probably don't remember this, but one of the things that strikes me as I think back to that time is how everyone at the conference talked about their forecasts, their expectations, what was going to happen. And I don't remember a single person that said COVID was going to have anything to do with it.
Right.
And it got me thinking, that's what financial professionals, portfolio managers have to deal with, this sort of uncertain future. How do you deal with that as a strategist, as someone who's been on Wall Street for a long time, that uncertainty about what's coming down the road?
Ryan, it's interesting that you bring that up, that we start with this topic, because I think that the data show that investors are habitually under-diversified. And why is that? Because nobody wants something in their portfolio that they hate. Right? Like, you know, everybody has a view of the world, and they say, this is my view of the world, and the portfolio is supposed to adhere to that view of the world. But you don't have anything that's an insurance policy in case you're wrong. And why don't you have that? Because that's a drag on performance. And we're all geared to thinking we have to be the best performer, we have to be number one, everything else. But realistically, if you're going to be diversified, that's an insurance policy, and the cost of that insurance policy is lower returns, steadier, but lower returns. And so if you think about COVID and things like that, you know, there's no way a risk model can anticipate a pandemic. That's never going to happen. But the question was, did people have something in their portfolio that protected them in case their view of the world turned out to be wrong? And the answer to that was no. And I think, you know, even today, if you think about it, people are punting anything that's diminishing performance. You know, financial advisors are under tremendous pressure from their clients because they're seeing CNBC telling them that the market is up and everything's racing. And so FAs are under an immense amount of pressure to try to keep up. How do you do that? You punt everything that's not keeping up. You shun diversification. And the data show that's what's actually starting to happen. It's not starting, it's happening.
There have been some really weird, weird market dynamics. And you mentioned this to me yesterday, actually, when we were talking about what we're going to talk about today. And I wasn't even sure that I had seen this before, so I'll give you credit for recognizing it. But you pointed out that large cap stocks were outperforming small caps. At the same time, high yield bonds were outperforming high quality bonds. And that doesn't seem like it should work at the same time. Those things going in opposite directions, that seems odd. And so how do you explain what's happening there?
It's really bizarre. I mean, you know, I think you're downplaying this a little bit. In my mind, this is incredibly bizarre that historically the bond market and the stock market work in tandem. If junk bonds are outperforming, junk stocks either are outperforming or will soon outperform. When quality bonds are outperforming, quality stocks will outperform or soon outperform. And it's just a function of profitability, of cash flows, of everything. If the credit quality of junky companies is getting better, it probably means their profits and cash flows are getting stronger, and it goes hand in hand, right? If things are getting worse, it's going to affect both markets. So what we have right now is a situation where junk bonds are outperforming. Credit spreads are ridiculously tight, by some measures historically tight, but yet we have large cap stocks, in fact, a very narrow universe of large cap stocks destroying small cap stocks. That is completely bizarre. The bond market is telling you that corporate profits are going to be stronger. The stock market is telling you emphatically that companies are going to go bankrupt, that there's only 7 companies in the world that you should be investing in. I mean, that is a very bizarre dichotomy.
So which one's right?
I kind of think that the small cap side is right. That the junk bond market is correct. That this large cap phenomenon we're seeing is much more speculative and bubble-like than people think. I mean, Goldman Sachs put out a report that showed that this is the narrowest stock market we've had since the Great Depression. Now, you could argue in the Great Depression that makes perfect sense. Companies are going bankrupt right and left. There's only a handful that are surviving. Narrow leadership makes sense, right, in a Great Depression. The profit cycle is now accelerating in the United States. Profits growth is going to be up this year between 10, 15, maybe 20% in the United States. Why in the world do we have this narrow leadership? There's 170 companies just in the S&P now growing earnings 25% or more.
So it's not just those Mag 7 that are growing their earnings.
No, not at all. There's nothing unique about them. That's what's so amazing about what's going on here. So I think the junk bond market has this one right. And the stock market is in some kind of strange bubble or at least speculative period.
When you say the stock market, you're talking about the broad indexes like the S&P 500, that are so heavily weighted, or maybe the overall market, like you said, is very concentrated.
It's extraordinarily so.
I don't want to put words in your mouth, but it sounds like you're saying some of the smaller stocks within the market are where investors should maybe find opportunities outside of just the largest companies.
Absolutely. So, Ryan, the way we've described it is to think that there is no stock market. CNBC likes to talk about the market, or Bloomberg or Fox or whatever you like to listen to. They talk about the market. There is no the market right now. Rather, it's a seesaw. And on one side of the seesaw, we basically have 7 companies. Okay, maybe you want to make it 5, maybe you want to get 20. People are going to get the point. One side, you get this very narrow leadership. On the other side of the seesaw, you have everything else in the global equity market. And our portfolios are positioned on the other side of the seesaw. We think this is a once-in-a-generation opportunity, that we haven't seen this since the tech bubble in 99 and 2000. And people say, wow, who cares about it? It was 24 years ago. Yeah, but we put out a report today that points out that since the peak of the bubble in March of 2000, energy stocks have outperformed technology stocks over the last 24 years. So this is a big deal, and nobody cares. So it was really pretty wild.
And that was a pretty concentrated market as well,
very much so.
In the lead up to the dot-com bubble.
Correct. The difference was it wasn't like 7 companies becoming 30%. It was one sector becoming 30%. This is actually a little bit more extreme than that was back then. Because it's only, a handful of companies.
Another market dynamic, or maybe economic dynamic, that seems a little bit counterintuitive is when you look at, say, the manufacturing PMIs. 17 out of 18 of the last months, you've had negative or contraction below 50. But at the same time, you're seeing, over that same time period, a lot of growth in construction of factories, which that seems like that shouldn't happen at the same time. We've got a contracting manufacturing sector. At the same time, we're building a bunch of factories.
Right.
What gives there?
First of all, we have to admit that some of this is because of the CHIPS Act, right? You're seeing the CHIPS Act was very powerful. It's having the effect that it was supposed to have. You are seeing manufacturing, the structures, whether that's semiconductors or related. You're seeing that build up, and that was the whole point of that, and it's working effectively, whether you like it or not. Politically, you could say, but it is working. That there's 2 separate issues there. That's number one. Number 2 is that I think people are still a little too short-sighted with respect to the manufacturing sector in the United States. I would argue the manufacturing sector is the growth sector for the next 20 years. It's not technology. It's not AI. It's not all this hype you're hearing. It is actually in the reindustrialization of America. And the reason that's so important is that the United States has a massive trade deficit. In fact, this morning it came out. It almost hit $100 billion for the month. This is it's the biggest trade deficit we've had in 4 years now. We've got that massive trade deficit combined with deglobalization. Now, the way I describe this to people is, and this is the government program already, why does everybody understand the national security implications of the United States being dependent on the rest of the world for semiconductors, but they don't understand the national security implications of the United States being dependent on the rest of the world for everything? And that, I think, deglobalization, being dependent on the rest of the world for everything, is a horrific combination. The capital markets have to be smart enough to understand this and redirect capital to where it's needed. I think the big story is the reindustrialization of the American economy. I think that's going to be a massive story.
So do you think then that, I agree with you, but do you think then that the CHIPS Act just pulled forward spending that would have happened anyway? I mean, the semiconductor companies, they have a lot of capacity constraints at this point. They're pumping out semiconductors as quickly as they can. And so sometimes I wonder, it seems like a no-brainer if you're one of these semiconductor companies that you're going to accept the CHIPS Act
why
money,
not?
right?
Why not? Right.
But it seems like maybe they would have spent that money anyways.
I think they might have spent it. I'm not sure they would have spent it here in the United States.
Oh, okay.
That's the difference, I think. I think the government has pushed them, and I think, again, I'm not getting into the politics here. I think that the smart thing that the government did was to try to reward companies for behavior that helps the American economy and makes the American economy more independent, as opposed to just saying, we're going to give you a tax cut. And then they go build another plant in Taiwan. I mean, what does that do for us? Many technology companies have gotten tax cuts and they build factories all over the world, but not here, right? This is a story of building them here. I think semiconductors are the tip of the iceberg. I think we're going to see this in a lot of industries where it may not be government outright spending, it may be tax incentives. Build a plant here, it's non-taxable for 20 years. They're going to get creative about it. But I think you're going to see it in a lot of different industries because we're going to have to reassert our economic independence.
So you've been talking about deglobalization and the reindustrialization of America for over a decade? Is that
it's about 10, 11 years, absolutely.
When you were 10, 11 years ago first talking about this, what was your thinking then as compared to now? Has it evolved at all, or is it same rationale?
It's a little bit different. It's a little more immediate right now because now globalization is actively contracting. Right, you're seeing this in the Middle East. You're seeing it in Eastern Europe. You're seeing it in our relationship with China. You're seeing it in parts of Africa. You're seeing it in parts of Latin America. Deglobalization is happening now. So the immediacy is greater than. 10 years ago, the story was that it was a simpler story in that companies had moved overseas for one factor. And the one factor was labor costs, and that was it. And they didn't understand the cost of logistics, the political costs, which we're now, as deglobalization is happening, this is one of the big issues. But they didn't understand the political costs. They didn't understand the quality control, the decentralized industrialization, that different factories weren't talking to each other. And so, there were a lot of things that were going on there. What's happened is this has been pushed to the forefront because of the political issues that we thought, were one of many issues back then. But now the political issues or geopolitical issues have pushed it to the forefront immediately.
So is deglobalization happening just between the U.S. and some of our trading partners, or is it happening outside the U.S. with the trade relationships in some of the other countries as well?
It's happening everywhere right now. I mean, in some places it's opening up. I mean, if you think about China, and China's trying to establish relationships in the Middle East, they're trying to establish relationships in Africa. You can see that where they're trying to globalize more to kind of replace our market, right? If they're not, if it's not going to work here, they're going to try and sell someplace else. But the deglobalization theme is in politics all around the world right now. And again, I'm not getting into the politics. I'm not saying this is right or wrong. Please don't misunderstand. But I think everybody knows that there are nationalistic tendencies in many countries around the world. And one of the big themes of nationalism is that globalization's bad. Well, if globalization's bad, and I'm not passing judgment, you could say that's right or wrong. I don't really care. That's not my day job. But if globalization's bad, you have to realize the United States economy is very dependent on globalization. And so what's going to happen to the U.S. economy as nationalistic tendencies grow? So again, you could say nationalism's good or bad. We just have to, as investors, we have to try to figure out what the implications are of that. And I think it means that the United States is really kind of wrong-footed here, and the capital markets are going to have to adjust.
So it seems like globalization over the last few decades, as we've sought lower labor costs and brought the cost of manufacturing down, has been disinflationary, even deflationary.
Yeah, absolutely.
So is the reverse true? Will this be, as deglobalization emerges over the next several years, is that going to be an inflationary force?
Yeah, I think that's right. I think that's absolutely right. Now, let's define what we mean by that first, so that
Yeah.
everybody, it's not a hair on fire forecast, right? Everybody's going, they all think that inflation is going to go rampant. No, I mean, inflation over the, from 1992 to roughly 2020 was about 2% a year. Right, and there's reasons I've chosen those dates, but let's say roughly those dates, 2% a year. Maybe we're talking 3% a year instead of 2% as a secular trend. Now that's not a hair on fire forecast, but if you compound that over 5, 10, 15, 20 years, that's a big difference in pricing. Why did I choose that period? If you look at when core PCE deflator, which is the Fed's favorite measure of inflation, starts hovering around 2%, it amazingly coincides with roughly the introduction of NAFTA. That was the beginning of the big period of globalization. And what globalization did was it just simply increased competition. And we all know that when you increase competition, you put downward pressure on prices. And so, as the United States, globalization did what your textbook said it should do. Production went to where it was most efficient. Unfortunately, that wasn't in the United States, but it went to where it was most efficient. Increased competition, downward pressure on prices. We now call that secular disinflation. If we're now going to deglobalize and production is going to go to where it's less efficient, you'd have to say that there's going to be more rather than less inflation. Is that going to be 2.5? Is it going to be 3? I wish I was smart enough to tell you. But I think everybody should be positioning portfolios, and we are, for certainly at RBA, positioning portfolios for more inflation rather than less.
One of the I guess factors that could push more disinflation, at least in our view, is some of the technology that always has a disinflationary impact. And AI, everyone's very enthusiastic about AI and the potential and what that could do.
Right.
And one of the things I hear about is the impact on labor costs of that on white collar jobs. But then you've also got robotics and automation in factories and manufacturing, which also could have a disinflationary impact.
Absolutely.
Does that play into your thinking? And
it
especially, does. I'm just thinking like you're making the argument that labor costs are high here, and so go overseas was a couple decades ago the mantra. But if you can automate that, then that brings down costs and maybe leads to deglobalization.
So I have several answers to your question. Of
It was
course.
a long question.
I don't know. I have some, but number one, there's an economist at MIT whose name has escaped me right now, but it's not important, not germane to the discussion, who points out that about 100 or 125 years ago, 40% of all jobs in the United States were in agriculture.
Right.
And if you went to that 40% of the population and you said 100 years from now, like today, jobs in agriculture will comprise 4% of the working population, what would they have said? They would have said, oh, the world's going to come to an end. Everybody's going to lose their jobs, everything else. And he points out, his line, not mine, they would not have said, it's okay, I'll become a website designer.
Right.
Right? We have no idea the jobs that will be created from this. So I think we have to downplay some of the hysteria that AI is going to cause us all to be unemployed and we're going to be stupid and the robots are taking over and all this kind of stuff. Let's downplay that a little bit. The second thing is that technology always changes the economy. Always. Why, people say to me, isn't AI going to change the economy? My answer is, of course it will. I mean, why wouldn't it? Of course it will. I mean, technology always does. My favorite example, which we don't even consider technology anymore, is the light bulb, right? The light bulb turned the economy into a 24-hour economy, right? I mean, you can't have a graveyard shift when there's no light bulb. We couldn't do this right now without light bulbs, right? I mean, think about it. So we're doing this by candlelight. Imagine that, right? Forgetting that the cameras didn't exist or anything else. But so technology always changes the economy. But remember, we're investors. And as an investor, you have to separate out the economic story from the investment story. The economic story may be very good. That doesn't mean the investment story is going to be good. Case in point, 25 years ago, the story was the internet would change the economy. And it did. It changed the economy in ways that we could never have envisioned 25 years ago. I mean, fantastic, right? But if you bought NASDAQ at the peak of the bubble, it took you 14 years just to break even. Since the peak of the bubble, I mentioned before, energy stocks have outperformed technology stocks 24, 25 years. It takes a long time to make up for, overenthusiasm on the investment side. So I don't dispute for a second that AI is going to change the economy. Of course it will. Does that mean it's a great investment opportunity today? Not so sure about that.
Yeah, there is something to the hype cycle, and to your point, I think it depends where you are in that hype cycle.
Exactly.
If you invested in internet stocks too early, then it took 14 years to make your money back.
Yeah.
In some cases. So thinking again about this theme of deglobalization, it seems to me that a lot of it was pulled forward by COVID, the pandemic, and just the realization of, maybe our supply chains aren't quite as secure as we thought, and some other factors along with that. Do you think
Absolutely. I mean, I think COVID kind of exposed the soft underbelly of the U.S. economy.
Yeah.
Right. That all of a sudden we couldn't get anything, and it was really because all the supply chains around the world, seized up. And that's my point. Like, if in any kind of serious environment, those supply chains are going to seize up. What does that mean for our economy? And I think semiconductors are the most obvious of points for that, especially because a lot of semiconductors are made in Taiwan, which is right next to China. Of course, we all get that. We all understand that. My point is that's the tip of the iceberg.
Yeah.
Most people don't understand yet that the bulk of the economy is based on this. Remember, we couldn't get toilet paper. I mean, this is silly stuff, but it just shows that soft underbelly of the economy and how susceptible we are to being beholden to the rest of the world.
There was a stretch there where you couldn't buy a new car. All the lots were empty because we couldn't find the chips to put in these cars.
Exactly. I mean, think about that. It's crazy. But I think that was kind of the shot across the bow, if you will, in terms of what the future was holding.
You mentioned the energy sector, and one of the things I've been thinking about recently is the impact of some of the technology on demand for energy. If you've got AI server farms that are running all the time, and you've got cryptocurrency mining happening, and you've got a shift towards electrification in your vehicles and in your homes, it seems like that's a lot of energy demand.
I think one of the best stories out there is utility infrastructure.
Yeah.
Right. I mean, we all know that California has that law that by 2035, all vehicles sold in the state of California have to be electric vehicles. Again, we could argue all day long, is that good or bad public policy? I don't care. Not my day job. But we all know the California electric grid can't support that. So is it a better investment theme to invest in electric vehicle companies, or is it a better investment theme to invest in the industrial companies that are going to build out California's electric grid? At RBA, we're all over those industrial companies that are going to build out the electric grid. And it's not just California. The country has an antiquated electric grid that's basically using technology developed in the early 1900s. It hasn't really changed, which is amazing. There is ways to change this, and believe it or not, I mean, I'm not pandering for this, but the government has just relieved a lot of regulations on the utility industry to allow them to upgrade their transmission systems. Whether they do or not remains to be seen, but we'll see. But it's a huge story that nobody talks about. You don't wake anybody up at a cocktail party talking about what's it called? Reconductivity. Yeah, is the term the electrical engineers use.
Yeah. Bloomberg had a statistic in one of the reports that I read, it was a year or two ago now, but I think it was $14 trillion in capital investment over the next 3 decades globally on the power grid and modernizing it, making it more digital, making it more efficient. That's a lot of money.
It's absolutely crazy. I mean, there was an article this week, I can't remember where it was, maybe the Wall Street Journal, Washington Post actually, I think it was, that talked about new conductivity wires where, the old wires are basically copper or steel wrapped with aluminum.
Yeah.
They don't do well in the heat. There's actually new wires, and just by changing the wires, you don't have to change the poles. All you got to do is change the wires. You could double the capacity of the U.S. electric grid. Just like that.
Yeah.
It's crazy. So we'll see. I think that's a great, but nobody gets excited about a cable company.
Yeah, they're not nearly as flashy as an AI company.
No, not at all.
All right, so you have stated a couple times you don't want to get into politics. I'm not going to push you into politics. But what I will ask you is, does it matter who the next president is or who the composition? I mean, do those things have a big impact on equities, or should investors and advisors just kind of set them aside and recognize we go through cycles?
I'm smiling. I'm kind of laughing. Every presidential election in my entire career, which goes back all the way now to 1980, whoever loses the presidential election says the market's doomed. It never fails,
Yeah.
right? I mean, 1980, Jimmy Carter loses to Ronald Reagan. The Democrats say the market's doomed. Of course, we have a bull market, right? You go on to, say, Clinton, the Republicans say the market's doomed, we have a bull market. You go to Obama, the Republicans say the market's doomed, we have a bull market. You go to Trump, the Republicans say, or the Democrats say the market's doomed, we have a bull market.
Yeah.
Biden, the Republicans say the market's doomed, we have a bull market. I mean, I just think, everybody's got to chill a little bit. The world is not coming to an end just because the other side wins, and I think there's 40 plus years of history there to say, no, I don't know what went on before, but so I don't think it makes that much difference. I think the biggest issue in politics right now is what I mentioned before, that not just here in the United States, but in many countries around the world, this is not a U.S. phenomenon, nationalistic tendencies are growing. And as an investor, you cannot ignore that, because globalization, I would argue, was the major factor that caused secular disinflation. And so you can't sit here and say politics are changing around the world. Nothing's going to change in the financial markets. Nothing's going to change in the global economy. That doesn't make any sense. And so that I think people are too myopically focused on Biden and Trump and not thinking of the bigger issue around the world that's going on here and what that could mean for their portfolios.
So with the period of secular disinflation maybe going away, is the Fed going to have a more difficult time bringing inflation down to their 2% target? Is this something they're going to have to rethink?
RBA, I think all my colleagues would agree with me, rather, that it's very unlikely they're going to hit that 2% target without a sustained period of weakness in the economy, right? Yeah, I mean, if we have a recession, a deep recession, make it as bad as you want, yes, we'll hit 2% inflation, of course.
Right.
But if there's a healthy economy, the trend line is not going to be 2% anymore.
Yeah. Are you surprised that the Fed, having raised rates as much as they have so far this cycle, that they haven't had a bigger impact on economic growth?
Yeah, it's a great question, Ryan. There is no economic model out there that says that the Fed raises interest rates 525 basis points and financial conditions ease. It's lunacy to think that would happen, but that is what's happening.
Yeah.
So there's many reasons why that's happening. You could argue that we had 27% money growth several years ago, which rivaled us with Peru, something we should all be proud of. And you don't wash out 27% money growth in a short period of time. That's two and change times the fastest money growth ever in modern U.S. history. It just doesn't wash out in a year or two. And so you still got the lingering effects of that. Plus, you've got the fiscal stimulus involved and everything else. So we've got a huge amount of oomph to the economy that's not going away. I'm not sure the Fed has adequately assessed those factors, and they're just kind of going by history and saying, well, we raised rates 525 basis points. That should be slowing the economy. It's questionable, but certainly financial conditions are not tightening, and that's really a big thing. FAs, financial advisors, see this every day. All they have to do is think about how many private debt deals they are seeing every day, and they're witnessing financial conditions not tightening. If the Fed had their desired effect, the banking and monetary system would be really clamping down on lending. Well, that's not happening.
You were very early in saying that the Fed was not going to be nearly as aggressive in lowering rates this year as the market had priced in. Coming into the year, it was somewhere between 125 and 150 basis points priced in, something like that, right?
Right. It was 6 times.
And 6 times. And now I think we're maybe at 1 time or something like that.
Yeah.
I think a few months ago you were one of the few people that I talked to that said it might not happen this year. Is that still your expectation?
It's still our view. I mean, my colleagues and I at RBA were very confused how the markets were anticipating 6 rate cuts during the year. The leading indicators of the economy had troughed, something that people don't talk about, but the leading indicators had troughed. They're not strong on an absolute basis, but they have troughed. That's not usually a sign that the Fed is going to be cutting rates, right? I mean, occasionally they do, but it just didn't sound right. Plus, we have the profit cycle revving up, going from minus 15% growth to plus 15% growth. Again, something that not really conducive to the Fed cutting rates. So all of us thought that the 6 was way too aggressive. Now, I'm not going to tell you that everybody in our firm agreed that they weren't going to cut at all, but we knew that 6 was way too aggressive. That was pretty clear. And so what you find, which is really interesting, is on days where it looks like the Fed is going to make the cut, and like you get a bit of data weakness and everybody thinks the Fed's going to cut rates, you find the speculative activity in the financial markets picks up immediately. It's an amazing, and then you get some data that's stronger and it all calms down. And so that's something I think the Fed probably doesn't pay attention to but should, because it tells you there's still too much excess liquidity in the economy to be speculated with. When the Fed has done their jobs, people aren't speculating. It's like you don't go to a casino when financial conditions are really tight and you're probably out of work. But here you have, casinos are doing well, speculative activity is doing well, cryptocurrencies are, you can see all the speculation still in the economy. That suggests the Fed hasn't gone enough.
So this is maybe a philosophical question for if you're a financial advisor or someone else that's advising investor wealth. Do we pay too much attention to what the Fed is doing? I mean, as you mentioned, this kind of ebbs and flows, the speculative activity based on expectations, what the Fed's going to do. It's what CNBC and Bloomberg and Fox, what everyone's talking about.
Right.
Do we talk about it too much, or should we just?
You're aware, and some people watching this probably are. I used to be a professor in the grad school at NYU, and one of the things I used to discuss a lot with the MBA students was the definition of leading, coincident, and lagging indicators, and the importance of, as an investor, you have to focus on leading indicators, but for some reason, investors tend to focus on lagging indicators, and like that intuitively that shouldn't make sense to people, but it continues. What are leading indicators? Well, leading indicators are things like building permits and jobless claims, which like CNBC spends a nanosecond talking about. It's like, okay, building permits were up, let's go on to something else, and that was it. Lagging indicators are things like unemployment, inflation, and the Fed.
Mm-hmm.
Look what everybody talks about: inflation, unemployment, and the Fed. And so, do people spend too much time thinking about the Fed? Yes, I've always been confused as to why investors believe that the Fed starts something when in fact they're reacting. And Janet Yellen used to talk about this very openly, although she didn't use my words. She kept saying how they were going to be data dependent. And I always thought that was funny because, like, what were they before? If this was something new, were they just winging it? But on the other hand, what she was saying, more seriously, what she was saying was that the economy is going to do something, the data is going to be reported, the Fed's going to analyze the data, and then set monetary policy. Well, think about that lag time between when the economy acts, the data gets reported, they analyze the data, and then they set monetary policy. That's like the definition of a lagging indicator.
Right.
So I do think that people spend way too much time thinking about the Fed.
Yeah. Okay. You mentioned the profit cycle, and that it has shifted a bit. So are we really early in that shift? Do you think that'll be something that continues to trend in the direction of profit growth?
So far, it looks to us that we've got another several quarters of accelerating profits growth, which we think will take us through the end of 24, maybe into 25, early 25. It's hard to say exactly, but it does look like we're on the upturn in corporate profits. And I think, as I said before, there's now like 170 companies in the S&P growing earnings 25% or more. This is the normal stuff that tends to happen.
Yeah. The
abnormal thing is that leadership isn't broadening. As fundamentals broaden, the market tends to broaden. Fundamentals are broadening, the market's not broadening. That's the weird thing. That's why I think at RBA we think this is much more speculative than other people do.
Yeah, and there's a big difference in valuations from one sector to another. As we've talked about energy a couple times now. Those stocks are still much, much cheaper than some of the other higher growth areas. And same thing with utilities. I mean, they used to be coming into the pandemic. Everyone was piling into low volatility, and those got expensive, but not so much anymore.
No, I think the hype machine is all 8 cylinders of the hype machine are going big time right now, and I just think, to get back to my seesaw analogy, I think because that seesaw is so skewed, the other side of the seesaw, which we're positioned in, is literally a once-in-a-generation opportunity. You don't see this very often. And so I would encourage everybody to take their eyes off the 10 minutes. These things don't work by the next commercial break. That's not the way investing actually works. And think about the next 1, 3, 5, 10 years where these opportunities are. I think they're huge. I mean, I'm actually quite excited about one side of the seesaw, but because you're not excited about the other side of the seesaw, people paint you as being bearish.
Right.
And that makes little sense to me.
Thank you so much for your insight. I have one more question for you that, I think one of the things that I like to try to do is broaden what I'm reading outside of, the Wall Street Journal or the, New York Times or Washington Post. So I like to read books, and
Okay.
I'm always looking for a good book recommendation. So do you have any books that you've either read recently? It could be a old but good sort of book, or anything on the horizon that you would recommend myself and the viewers of the ROI podcast consider.
So I actually just finished, by just I mean last week, finished a book called Dark Towers. It is the modern history of Deutsche Bank.
Really?
And
Dark Towers.
this was particularly fascinating to me because I knew some of the players. I had forgotten that a lot of the people that that formed the new Deutsche Bank all came from Merrill Lynch, where I had spent 20 years. That was early in my career at Merrill. I didn't know them personally. I don't want to say like we were buddies or anything. But I do remember the names, and they all came from Merrill. But I never kind of understood what happened when they left Merrill. And it's a very interesting story of taking too much risk, the desire to take risk, the lack of accountability, the lack of oversight, and all this, and what happens within a bank when you don't have those checks and balances within the bank. There's many stories. It's not a unique story.
Yeah.
This has happened in many places. Many banks along the way have failed. We saw one, a year and a half or 2 years ago, Silicon Valley Bank and things like that. But this is a very interesting story of how different divisions in a bank didn't talk to each other, all kinds of things like that. Very, very interesting.
Yeah. Well, thanks for the recommendation. Once again, thanks for coming on the podcast and for all your insights and for all that you do for financial advisors.
Yeah. Well, thanks. Thanks, Ryan.
And thanks to all of you for joining us on the ROI podcast. We'll see you next time.